Thank you all for dialing in. We have a large number of people who have registered and will allow a moment for people to come into the room. Due to the large number of guests, we will not be taking questions from the audience and would ask that you direct all questions after the call to your CBA Relationship Manager. I will now hand the call over to James Plowman, Executive Director, Institutional FX Sales at CBA. Please go ahead.
Thank you. Well, good morning, everyone, and welcome to the CBA RBA update call, and thank you for taking the time to join. We really appreciate so many of you continuing to dial into these monthly calls and using this time to seek out the latest insights from the RBA economics team and how these announcements impact institutions, corporates, businesses, and households alike. For today's call, I'm delighted to welcome back Senior Economist at CBA, Belinda Allen, who will go into details about Tuesday's RBA's announcement and more closely what this means for the Australian economy. Well, Belinda, the RBA held the cash rate at 4.1% this week, and for many economists and market participants, it was probably a bit of a line ball call. Perhaps you could start by setting the scene, providing an overview of the RBA's announcement on Tuesday.
Thanks, James, and good morning to everyone who is dialing today. I'd like to reiterate what James said. We really appreciate you taking time out of your busy days to listen to our views on what is happening at the Reserve Bank of Australia and what it means for the economy. We know there's been quite a few of these calls over the past 15 months or so, given the large number of interest rate hikes the Reserve Bank has delivered since May 2022. And James, as you said at the start, it was going to be another line ball call from the Reserve Bank in August, and that was definitely the case. For those of you who followed our call leading into the August meeting, we had expected a rate hike on Tuesday, as did a majority of economists. Financial markets, in contrast, had only priced in a small chance of a rate hike. Instead, the Reserve Bank left the cash rate on hold at 4.1%. So that was the second consecutive on-hold decision from the Reserve Bank, who also held the cash rate steady in July. So going into that meeting, I really outlined our view about whether or not the RBA would hold the cash rate or hike. Obviously, on the balance, the decisions and the arguments to hold the cash rate steady kind of won out. So a lot of that really came down by the RBA, by the fact that interest rates had been increased by so much already. You know, the cash rate now at 4.1%, starting at 0.1%, that's a 400 basis point increase over the past 15 months. And one thing the Reserve Bank said in its statement is that these higher interest rates are working. So clearly the fall in inflation that we've seen over the past 6 months is giving them more comfort that they've prevented any upside risk to inflation on current data. So there's much more of a sustainable balance between demand and supply at the moment. So the data that they're looking at on prices, that's coming down. And in terms of demand in the economy, it's pretty evident that household consumption's coming off as well. So there's a better balance between those two elements at the moment. The RBA, in also leaving the cash rate on hold, highlighted the uncertainty around the economic outlook at the moment. So the economy is slowing, and one of the things the Reserve Bank has been very much focused on in its interest rate hiking cycle is keeping the economy on an even keel. So they're taking longer to bring the inflation back down towards target compared to other central banks around the world, and they've done that to try to preserve the gains in the labour market that have occurred over the past 3 years. So I guess for them, they're trying to keep the economy on an even keel, keep that resilience in the labour market and bring inflation back down. They are just, I guess, concerned about the uncertainties surrounding the economic outlook. They don't want to engineer a slower or a faster slowdown in the economy than their aim. So that was another decision, another reason that factored into their on-hold decision. And once again, they also made the comment that by leaving the cash rate on hold, they'll have further time to assess the economic outlook and the impact of higher interest rates. So those three reasons were very much used in the July statement as well, so very similar. And then, of course, what you've seen between the July meeting and the August meeting is the flow of economic data. So when we look back at that flow of economic data, there's been kind of two softer prints. We had a slightly lower second quarter inflation print. So that, I guess, did give them more comfort that inflation was coming down. We also got a weaker retail trade print for June that fell by 0.8%. So retail trade over the June quarter was quite soft. Whereas on the flip side, we did have a stronger piece of economic data in terms of the labour market. So if we think back to the June print for the labour market, we had the unemployment rate print at 3.5%. We had another really strong gain in employment growth. So the data flow was mixed, but it seems the data flow also gave them more reason to think that these higher interest rates are working. So they didn't need to then deliver another rate hike in August. We thought they may want to go down the path of least regret in providing another rate hike, that lingering concerns around upside risk to inflation, particularly on the services side, which we do know did continue to accelerate in the second quarter. And they did highlight that in the statement. And also concerns around rent inflation, pass-through of higher inflation through to wages, that higher award wage decision could mean that they would prefer just to take out, I guess, another insurance and lift the cash rate kind of one more time. But certainly they've chosen to leave the interest rates on hold. And at the moment, the statement seems to really highlight that they're comfortable with the balance of risks around the economic outlook, particularly around the prices and wages side. So because of that, we think the hurdle to hike rates, again, is quite high. So as a result of that second on-hold decision from the Reserve Bank, we have removed that last rate hike from our profile. So we do now expect the Reserve Bank to be on hold at 4.1% for an extended period of time. We do acknowledge, though, that the risk does remain for another rate hike from here. They do retain a tightening bias in their forward guidance, but we think the onus is on the economic data to suggest that they need to lift interest rates again. And our read on the current situation in terms of prices, in terms of wages, and in terms of consumer spending, the three things they're really looking at, we just can't see that data flow really surprising to the upside to force the RBA into hiking interest rates again. So just to reiterate, we do expect 4.1% to be the peak in terms of this interest rate hiking cycle. We expect the RBA to leave interest rates on hold for the remainder of 2023. The data flow, as I said, is important to watch, but we do expect to see inflation continue to come back down. We expect the consumer to continue to slow, given the delays in the pass-through of interest rate hikes onto high mortgage repayments, the roll-off of the very large fixed-rate mortgages that's currently underway, the fact that we have negative real household disposable income. We think the data flow from here keeps the RBA on hold for the remainder of this year. That might be a good time for me to pause, James, and I'll hand it back to you and we can dive into some questions. Thanks.
That's great, Belinda. Thank you very much, and very comprehensive overview and update there. Plenty for everyone to digest, I suppose, and I think there's probably a lot of questions which are lingering in people's minds. I unfortunately can't read everyone's mind on the call, but I think if we look to a few questions and we kick a few things off, obviously as we've talked about the inflation print. So the Q2 CPI printed a lot lower than expected, but the services inflation rose. What are your expectations around the inflation numbers going forward? And, I mean, I suppose we could look internationally, and how do you think that compares?
Yeah, it's a good question, and I think the Reserve Bank probably over the past month have looked offshore, particularly at the US, and seen just how quickly the pace of headline inflation there has come down. So headline inflation there was 3% in June, so it has come off relatively quickly. Obviously, core inflation not coming off as quick. So there has been evidence offshore that inflation can come down. Despite still resilient labour markets, both here and globally, inflation is coming back down. And a lot of that is being driven by the goods side of the equation. So because supply chain disruptions have largely all been resolved, shipping costs are coming back down quite quickly as well, closer to pre-pandemic levels. We are now starting to see that pass through into goods prices coming off. Where we're not seeing as much, I guess, success or fall in prices is on the services side. So that certainly was reflected in the second quarter CPI print, where we did have services inflation step up again. It's now obviously higher than goods prices as well. And there's kind of, I guess, mixed reasons why services inflation is higher. So things like rents, restaurant meals, childcare, international travel, insurance are all showing signs of being sticky. So the RBA does remain concerned that you could see some pass through of that higher services inflation into wages, then back into inflation. We're not seeing signs of that at the moment, but they would be concerned that it does remain sticky and you get that pass through to wages, given the labour market here is still strong. We've still got a very low unemployment rate at 3.5%. And offshore, we are seeing some signs of wage price spirals in selected countries, particularly the UK, maybe now more of a risk of New Zealand as well. So the RBA would be, I guess, cautious of that, but they'll be pleased that inflation's coming back down. We have it falling quite quickly through the rest of this year as well. So from 6% in the second quarter this year, we have inflation just a touch below 4% by the end of this year. And obviously on Friday, we do get updated RBA forecasts for the economy and prices as well, which we'll keep an eye on.
Great, thank you. And I suppose that probably leads nicely then into, if we do have this data coming out and the monetary policy statement on Friday, tomorrow, what are CBA's expectations around some of those points within that policy statement?
Yeah, so we did get a little bit of a preview in terms of the RBA forecasts that are coming out tomorrow, as you said. Not a lot of detail. The RBA have said they do expect CPI to continue to decline from here and to be within 2 to 3% by late 2025. So tomorrow the RBA is going to be extending out their forecast from June 2025 to December 2025. So they had said that inflation should be around 3.25%. Around 3% in June 2025. They're now saying within target by the end of 2025. We obviously have it coming back down a little bit quicker from here. It doesn't look like they're going to make any major changes to their forecast on the labour market either. So they're currently expecting the unemployment rate to pick up to around 4.5% by late 2024. It's currently 3.5%. So kind of very similar to what we're expecting as well. We did have to make some changes to our forecast on the labour market after that very strong print a few weeks ago. We're not going to see as fast of a pickup in the unemployment rate than we expected. So that's another factor that we'll be looking at tomorrow. But on the whole, it doesn't look like they're going to make any wholesale changes to the economic forecast. So as you said, inflation did come in a little bit lower than expected, but not materially so. So it doesn't look like they're making any wholesale changes.
Okay, thank you. And if we continue that theme, I suppose, of the international side, and I mean, fully appreciate that this isn't your area of expertise, and CBA does have an international FOs team that we can touch on, but when we have seen this week, in the last 24 hours, Fitch, one of the credit rating agencies, downgraded the US. I suppose it'd be remiss not to look at that and delve a little bit deeper into it. If you would see kind of any similar scenario playing out here, I mean, we do have a lot of different conditions, but are there any things that we should be looking out for there?
Yeah, so thanks, James. So our international economics and FX team obviously have been looking at the developments in terms of the Fitch credit rating of US government debt. So yesterday they downgraded it from AAA to AA+. They had warned of a downgrade back in late May. So they have said that that downgrade reflects an expected further deterioration in the US fiscal position in coming years. Now, just an important, before I turn to the reflections on Australia, it's just important to note that over the next couple months, this is going to continue to be an issue. So the next pressure point for the US is when the government will run out of funding on 30th of September. So legislation will need to be passed so the government can continue non-essential spending after 30th of September. So there's going to be a lot of news around this coming up. That's worthwhile keeping an eye out for. It's obviously a very different situation here in Australia. So that for the financial year just ended, Australia is going to print a budget surplus of 20 billion, or even higher. So we're talking about budget surpluses here in Australia, whereas in the US, they're talking about further fiscal deterioration. So the very strong performance of the economy here in Australia, particularly the labour market, and obviously on the commodity price side, has meant that the budget position here has been a lot stronger than expected. And there has been some fiscal restraint exercised by the government. There hasn't been a lot of new spending measures announced either last financial year or into this current financial year. And even when we look at the budget position for FY24, the budget deficit that was forecast back in May was 13.9 billion. There is the chance that we might actually have a budget balance, or close to a budget surplus, if not a balanced budget for this financial year. So the positions are very stark between Australia and the US. One other factor here in Australia is we also are running a current account surplus as well. So we have a budget surplus and a current account surplus, which is obviously very different to what we're seeing in the US.
Thank you. And I suppose anyone on the call that would like to delve a little bit deeper into that, please feel free to reach out to your contacts at CBA, and they can provide some more insights and put you in contact with our internationals team. So thank you for that, though, giving your insights there, Belinda. If we look a bit further and keeping it offshore, we have a number of banks offshore, I suppose, coming into different cycles. We do have the Bank of England tonight as well, and that's expected to another hike, whether it's 25 or 50, so they're on a little bit of a different trajectory than here. But are there any kind of key points or observations that you can share from those kind of recent central bank meetings happening offshore that can possibly give a bit more insight into how things are developing globally, but then how also that can play out domestically?
Yeah, so it's a good question. So obviously, I mean, we work very closely with Joseph Capurso's team, with Christina Clifton and Carol Conn, just to really dive into these global thematics and what it can mean for Australia. So, I mean, central banks offshore are getting very close to the peak in their cash rate cycle, if not at the peak. So, I mean, we think the US Federal Reserve has finished its hiking cycle. Obviously, there's still, if you talk about the risks, there are still the risks of another rate hike, both here in Australia and in the US as well. But you're seeing this situation where inflation's coming back down, but labour markets are very resilient. So I think that's where the lingering risks are offshore. We are expecting further rate hikes on the Bank of England. So as you said, a big debate about whether or not 25 or 50 basis points tonight. We're expecting a 50 basis point hike. We still have the European Central Bank hiking again. But attention's going to turn pretty quickly, both here in Australia and offshore, about when central banks can turn from lifting the cash rate, so how long will they leave the cash rate on hold, and then when are rate cuts expected. So that's going to be a very similar conversation offshore to what we're having here in Australia. So, for example, in the US, we have the first rate cut from the US Federal Reserve in March next year. So that's kind of how, I guess, the timing we're expecting offshore, as long as you're seeing inflation come back down or continue to look closer to target.
Yeah, and a very nice segue, and probably a good way to round out the Q&A part of this call is you've talked about the CBA view now, where we're potentially looking for an extended pause from the RBA, and given that probably a little bit more on the dovish side of the market, we have seen some of the other commentators out there change their profiles as well. What are the drivers from here, do you think, and how do you think the rate cut profile essentially will look from here into year end, and then obviously into the beginning of 2024 and through 2024?
Yeah, it's a good question. So on Tuesday, when we changed our call that the RBA will now be on an extended pause, obviously that raises the question mark about, well, how long would that pause be? What could see the RBA start to cut interest rates? So for us, when we look at our forecast of the economy, both from the activity side but also the prices side, we do think there'll be an opportunity for the RBA to start to take the cash rate lower in the first quarter of 2024. Because we do have inflation coming back down relatively quickly over the second half of this year, then into the first half of next year, because we do have the unemployment rate lifting higher and the consumer slowing. So we have a slower growth profile in terms of GDP. We do think the opportunity is for the RBA to cut interest rates as early as March next year. So the risk does sit with a later rate cut cycle. So we do have the cash rate here in Australia moving from 4.1% to 3.1% by the end of next year, which we feel is closer to more of a neutral setting of interest rates here in Australia. So at the moment, probably also worth highlighting that in 2024, the Reserve Bank does move to a different meeting cycle. So at the moment, the RBA meets for 11 times a year on the first Tuesday each month, apart from January. Next year, they're meeting a total of 8 times. So the meeting schedule does change. So at the moment, we do have that first rate cut in the March meeting, which is the 18th to 19th of March. And then we do have, at the moment, in our profile, 1 rate cut each quarter for next year. So as I said, we really have that in our profile just because of how our economic forecasts are landing at this point in time. Inflation coming back down, growth well below a trend here in Australia. So we have GDP growth by the end of this year at well under 1%, and the unemployment rate moving up to 4.5% next year. So that really opens the door for the RBA, as I said, to move interest rates from the deeply restrictive territory we think they are in now to much more of a neutral setting by the end of next year. It's also probably just worthwhile highlighting just the data flow between now and the September meetings, because there does remain the risk of another rate hike. It's probably just worthwhile highlighting that between now and September, the 2 main data points to watch will be the second quarter wage price index that we get out on the 15th of this month. So we continue to expect wages growth to remain below 4% in this cycle. And then on the 30th of August, we get the monthly CPI print. So we know the RBA is very much closely watching the price side of things at the moment. So that inflation print on the 30th of this month will be worth watching, as well as obviously the labour market data we get out between now and then. But at this stage, as I said, RBA, we're expecting at the peak, economy slowing, inflation's coming back down, rate cuts in our forecast for 2024. As they are for the other central banks internationally that we cover, with the exception, obviously, of Japan and China, which are in a very different position at the moment.
Thank you. Well, look, that's fantastic, and obviously we've covered a lot of points. There's a lot of things coming up for the RBA. We've got a new governor, a new meeting profile, as you said. So very, very interesting times ahead. So look, I mean, thank you very much today for sharing your thoughts and insights. It's great to have everyone still dialing into these calls. For CBA, look, this is a really important call for us, and it's fantastic that we can give you these insights, and where possible we can draw on CBA's own data to highlight what's going on in the economy. It'd be remiss of me as well, just a little plug. Obviously, we do have, for a lot of clients on the call, the Peter Lee survey coming up. This is a really important survey for the bank, for the global markets teams. So we really appreciate any feedback that you provide in those, and we thank you in advance for that feedback. And as always, look, I mean, if you've got any questions whatsoever from this call, or if there's anything that you are thinking about that you'd like to have answered or your thoughts questioned, please feel free to reach out to your CBA contact. We are always here. And look, thanks again to everyone for joining the call, and have a good day, and thanks, Belinda, and we'll chat again next month.